Think of some of the biggest companies in America. The S&P 500. Companies like Alphabet, Microsoft, Coca-Cola. These are the companies that dominate their industries, that are worth millions, that seemingly control the world. But what if I told you that behind those companies were actually two other companies? Two companies, BlackRock and Vanguard, appear in the top 5 shareholders in 90% of the S&P 500. This means that they have a controlling interest in some of the most powerful companies on Earth. But who are they? Should we be concerned? Let's dig a little bit deeper. To start with, you have to understand that we're not going to be conspiracy theorists here. We value the truth too much to engage in idle, paranoid speculation. Instead, the purpose of this video is simply to provide information and to let you draw your own conclusions. There is a key difference between owning something and investing in something. These two companies, BlackRock and Vanguard, do not own the S&P 500, they just heavily invest in it. And while this does give them tremendous power, it's not the same as owning a company. The simplest way to think about it is this. Imagine that 1,000 people each gave you $1,000 to invest on their behalf. You would pool it, buy shares in companies, and manage the portfolio. Technically, you hold these shares, but the underlying owners are still those 1,000 people who gave you their money. This is essentially what BlackRock and Vanguard do, just at a scale that's nearly incomprehensible to the average person. BlackRock was founded in 1988 by Larry Fink and 7 partners. It grew primarily through bond and risk management, but its real competitive advantage was a proprietary platform called Aladdin. The name has nothing to do with the Arabian Nights. Instead, it stands for Asset, Liability, Debt, and Derivative Investment Network. Aladdin doesn't just manage BlackRock's investments. It's licensed to pension funds, insurance companies, sovereign and wealth funds, and even other asset managers worldwide. Estimates suggest that Aladdin monitors risk on around $20 trillion in assets. This means that BlackRock's technology has a footprint even bigger than its already sizable investment footprint. Vanguard has a genuinely unusual structure, which is worth getting into because it affects how the company behaves. Founded in 1975 by John Bogle, it was built around a radical idea. Most actively managed funds failed to beat the market over time once fees were accounted for, so why not just track the market and charge minimal fees? Vanguard is structured so that its funds own the company itself. There are no external shareholders or private owners taking profit out. Any surplus is returned to the investors through lower fees. This means that Vanguard is, theoretically, the most conflict-free large financial institution on Earth. What this means is that when they invest in companies like Apple or Tesla, BlackRock and Vanguard are not simply holding shares for themselves or for wealthy individuals. They're also investing on behalf of pension funds, university endowments, and ordinary retirement accounts. And so, while they are large and powerful, these aren't exactly the monolithic evil entities that the internet sometimes makes them out to be. So how did these companies get so big? The answer is passive investing. The traditional model of investing involved fund managers actively picking stocks, and they would do this by analyzing companies, making calls, buying and selling. The problem is that most of these managers didn't consistently beat the average market return. They were expensive and, on average, not worth it. John Bogle's insight was simple and devastating to the active management industry. If you can't reliably beat the market, just become the market. Track everything, charge almost nothing, and let compounding do the work over decades. Vanguard launched the first index fund available to retail investors in 1976, originally to much derision. Instead, it turned out to be one of the most consequential financial innovations in history. As evidence began to mount that passive funds outperformed active funds over a long time period, money began to flow steadily from active management to passive management. That flow became a tidal wave after the 2008 financial crisis, when trust in active management and financial institutions essentially collapsed. The 2008 crisis is also in BlackRock's story. The U.S. Federal Reserve and the U.S. Treasury dealing with the collapse of Bear Stearns and the chaos surrounding mortgage-backed securities, needed someone who understood the complex financial institutions at the heart of the crisis well enough to value and manage them. That became BlackRock. The firm was essentially given the job of managing the government's response to the financial crisis. This was a level of institutional trust and proximity to power that no real precedent for a private asset manager. BlackRock did similar work for the European Central Bank during the Eurozone crisis. This is all documented public records, not conspiracy theories or speculation. The compounding effect of passive investing's growth is that every dollar that flows into an S&P 500 index fund at Vanguard or BlackRock automatically gets distributed across all 500 companies in proportion to their size. As trillions of dollars have made this journey, these firms' stake in individual companies have grown, not through any active decision, but as a mathematical consequence of their own success. For example, when it comes to banking, these companies are among the largest shareholders in JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup all at the same time. When it comes to technology, they're the top shareholders in Apple, Microsoft, Google, Amazon, and Meta. These 5 companies are the largest in the world by pure market capitalization. In fact, if these 5 companies were a country, they would make more than the entire GDP of every country on Earth except for the United States and China. When it comes to the media, they have a large stake in Disney, Comcast, and Warner Bros. Discovery simultaneously. This means that, just like with banking, no matter who wins among these competitors, BlackRock and Vanguard see the real bonus. Just because BlackRock and Vanguard hold shares in these companies, that doesn't mean they control editorial or business decisions. After all, a pension fund that owns shares in Disney, but they do have influence in the form of voting on corporate governance. When you own shares in a company, you typically get to vote on things like who sits on the board of directors, how executives get paid, and shareholder resolutions on issues like executive conduct or even climate policy. Because these 2 companies own so many shares, they have a huge chunk of the voting block. When the companies express an opinion or demand answers, some of the largest and most powerful companies on Earth are forced to pay attention. Of course, since they oftentimes own shares in all the players in a single industry, they have no interest in seeing one succeed over the other. Instead, they're interested in the health of the entire industry, not one over the other. For example, research has shown that airline prices have consistently risen despite the abundance of competition. This is because So, BlackRock and Vanguard have their fingers in almost every major part of American business. The interesting thing is that you probably do too, just without knowing it. If you have a workplace pension, a 401k, or an ISA, or really any kind of retirement savings product, there's a very strong possibility that at least Vanguard alone has over 50 million investors. BlackRock's iShares ETFs are among the most widely held investment products on Earth. So, in a meaningful sense, BlackRock and Vanguard are millions of ordinary people. Teachers, nurses, factory workers, and retirees whose savings are pulled together into a force large enough to be a top shareholder in Apple. This means that their power is real, but the ownership is diffuse. In the end, this goes to prove that the world's financial systems have concentrated into a shape that nobody quite planned and nobody entirely controls. Whether this is good or bad is a question that economists, regulators, policymakers, and average citizens are debating as we speak. So the next time you think about Apple, Microsoft, or Coca-Cola, these companies that seem to control the world, remember that behind them quietly sit the same 2 names. And behind those 2 names? Probably you.